G'day traders, Stacey Burke from Stacey Burke Trading, and today we're going to talk about looking for short-term trade setups using the end-of-day charts. Now, one of the things I look for on my hourly trading is, as you know, I primarily wait for the Asia close, but one of the things that I look at is the Monday-Tuesday initial balance from the end-of-day charts. So if you're not familiar with the initial balance or any of that work, read Dalton's book Mind Over Markets and Toby Crable's book. A lot of his stuff was short-term trading, narrow range breakouts, but the initial balance is primarily the first couple of trading sessions, first couple of in this particular case, being end of day, the first couple of sessions of the trading time frame. So end of day, Monday to Friday, Monday to Tuesday sort of sets the tone for the week. Now, it's very similar. One of the things we talk about with the opening range of London is that there's often a high or a low for the session between 2 a.m. and 5 a.m. New York. Typically, very similar also is that Monday to Friday, one of those two highs or lows will often act as a buying extreme for the week or a selling extreme for the week. Now, obviously, the last couple of months, the Japanese yen's been trading strongly, and oftentimes people will say, like when it's taken off like this, they're often afraid to get in because they're not sure if they're buying in at the top. And this is what could often be referred to as an always in trade, but obviously we don't know that at the time. But just coming back, remember the markets are always trying to either break out, pull back, fill orders and continue, break out, retest and fail and go into a trading range, or break out and pull back and setting itself up for a marginal new high or new low, which we call a false break, and then running strongly to the other side of the range. So one of the things that I will do is that on a Monday and a Tuesday, I will put the highs and lows for the 2 days. Now, obviously, the Japanese yen has been making higher highs and higher lows, and we can see that previous few weeks we've had a breakout and a pullback following Monday, bullish, but you can see that again, smart traders, institutional money, they're buying inside of that initial bar somewhere in this range. They're placing their stop below, somewhere in here, either below the bear bar, which of course you can see it touched, but more importantly, the range of this one candle, the market is layering on top of that. But what will happen is that when we see a market break out and do this again, we have a high and a low for the range for the week. Now, if we were to apply this to our short-term trading, and we're just looking at the Monday, Tuesday, we'll go to our hourly chart now, and what we'll see here is we had the Fed announcement that came in early on Wednesday, but again, more importantly, what we want to know is there a bar somewhere that we can see that the market's protecting? So on Monday we had a lope trade, low of the high period trade. So now we've got a selling range that we can identify on the hourly chart across, projecting that across throughout the week until that's broken. And now we also have a hope trade, which is the high of the low period, HLOP. Now again, I've talked about this in the other videos. Go get John Carter's book, Mastering the Trade. What's critical about this is that again, you want to see where a bear bar, a strong bear bar, has now been broken out from, and the market's protecting that price range. Now, obviously, going into the Fed announcement, the market pulled back to test week longs, but again, if you weren't long and you were looking to trade the announcement, critical is this right here, this bar right here. That confirms once this bar at the 17 o'clock candle breaks out and pulls back, now we've got a few opportunities again to enter into any of this long position. Again, we want to be able to either sell high or buy low, but we're looking for where the market can give us an indication where it's broken out, and now the market, where it was once bearish, is protecting that with long positions, or where it was once bullish is protecting that with short positions. So again, obviously the market consolidated on the Tuesday, Wednesday, and tightened into a narrower range, which again, traders, if you're starting to spot a rectangle pattern setting up, you know that the market is coiling. It's going to build up pressure, and this is an excellent opportunity for traders to, again, be able to identify their maximum amount of risk and look at positioning themselves before or into a move as it begins. So breakout traders would have entered in anywhere through this range, and then of course even on the follow through, once it broke out and cleared the previous range. And again, regardless of how they traded, whether it was purely on technicals, you can still identify your maximum amount of risk. Even though it's a large candle, traders may just reduce their percent of capital allocated to that one trade. And again, as we've spoke about, look at measured move projections, either of the previous range or a candle. So breakout traders would have definitely looked to take that range, project it up, and we can see that that market extended 2 3/4 its original breakout from that trade of the range from Monday, Tuesday, Wednesday. So just to look at another example, we'll look at the Canadian dollar. Again, just do this yourself. Go and find your Monday, Tuesday bars. Start marking them off. You see something like this, it's a 50% retracement, but also it's filling the gap from the breakout. You see breakout Monday, pullback Tuesday, Wednesday. There's ways to either position yourself just inside of the range, and there's your maximum risk, or the breakout again. But last week, again, if we spotted our high and low, the Monday, Tuesday range. So again, the other thing you might want to pay attention to is, in a particular case like the Canadian dollar, that you've had the market obviously very strongly down the last couple of weeks. We had a bullish pullback. Now, early bulls would have traded the breakout, but you're trading against the trend. Now, so let's go to our hourly chart again. So smart traders will look to see, again, something that will confirm that that level is going to, if they're trading intraday, going to give them an opportunity to either, again, trade with the trend short, or again, look for a bar that the market drives down bearishly, and then into the US session reverses and then breaks out again. So now again, we can identify our maximum amount of stop. We're looking to sort of buy low. The market continues. There's an opportunity to pyramid into these trades until it clears that original range. And then again, even if we follow that through to the following day, just talk about our, so notice how we don't see any breakout candles short until early in the Asia session. So again, now what we can do is identify a candle or a bar where the market originally, so we've got two breakout bars prior to Asia the following day. This market, this candle, into the US session. At the end of the US session, we had another breakout, then it consolidated into the early part of Asia, broke out again, reversed, pulled back, and then we had a small pin bar which early Asia traders may have traded. But again, now we see the bear candle pull back, so again aggressive. Bulls may have added another position in, inside bar into the London Open, and then again we've got our 1 bar candle from Asia, the London Open, where breakout traders could position themselves. And so again, looking for candles where the market was bearish but then failed. So you can see the early Asia bear candles were broken out from in London Open, but they pulled back. So this is important because a strong breakout, we want to know if that fails. And if that was a failure, this pin bar wouldn't have held. So bulls can re-enter on this confident, knowing that they're probably going to at least have a retest of that bear candle. But more importantly, early bulls trading with the trend, regardless of how you wanted to trade this. We'll just show you a little something here. Anything in that range below the high of that breakout candle from the US session was tradable to be long. Now the reason why that is that if you're going to go long, you can still see where the market is broken out, it's pulled back, it's found support probably roughly just above the 50% level of this candle, and then second position or third position was able to be re-entered into once it broke out again. So we've got a breakout, a pullback. This is just sideways action during Asia, but this candle's protecting its longs, and this is important that you look at that when you're going into the next day's trading session. You want to know where these candles are failing. Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.